Okay, so in this video, we're introducing Unit 4, Area of Study 1, looking at aggregate demand policies. And before we get into the actual key knowledge points that we're discussing, we want to think about in a very simplistic form what the government actually tries to achieve and what they do, how we might view them. And lastly, we want to do a quick recap about how we've interacted with the government in this course so far as well. And so it's easy to think about the government as the machine that runs our countries. And they set the objectives and they set certain goals in the country, and they implement different policies and different rules and different structures that allows us to achieve those different objectives. So for example, there could be a climate change focus, it could be an economic growth focus, it could be a humanitarian growth focus. Whichever the government is in power and whatever goals that they set, they are going to implement different policies that target those goals. And so let's think about how we've looked at the government so far in this whole year. We know that the government sets its macroeconomic goals, and these are the reminders here: economic growth, full employment, and low inflation. And we also know that the government, based on aggregate demand, has two types of spendings. Okay, it has G1, which is short-term spending, satisfying the immediate needs and wants of society. And then you also have G2, which is typically more about long-term spending, and it's usually around capital items or things to do with long-term productivity. And so we can identify the three main functions of the government. Number one is that they promote and pursue maximum resource allocation efficiency. They also try to pursue greater levels of equity in income and wealth distribution. And they also try to make sure that the macroeconomic activity is stable. And so we try not to run into inflation. We try to make sure our production levels are healthy, allowing us to achieve economic growth. And we also try to ensure that people have incomes which they can get through achieving full employment. Now in Area of Study 1, our focus is on aggregate demand policies. And there's two different sides that you can break it up into. We have budgetary policy, and we also have monetary policy that we look at a little bit in the future. That is related to the Reserve Bank of Australia. And you can think about the Reserve Bank of Australia as the government's personal bank. Now, even though budgetary policies and monetary policies are both related to aggregate demand, their functions are very different, and they are also separate from one another as well. Now, our first focus in Area of Study 1 is looking at the budgetary policies first. And so a quick summary, the differences between these two policies. So budgetary policy focuses on the taxation revenue that the government collects and looks at how they plan to spend that money to help stimulate aggregate demand, whereas monetary policy is more focused on the management of the total money supply in the economy. And so this means that if there's a greater supply of money circulating, that there's going to be more spending occurring. However, monetary policy can also reduce the money supply and therefore directly reducing the amount of spending that occurs. And the way the Reserve Bank of Australia achieves this change in money supply is through changing the cash rate, which is going to have a direct influence on the interest rates the economy faces as well. And so the key point is that these policies will both help stabilize or stimulate aggregate demand. Moving forward, some key terms that we need to be aware of and what we need to be able to interpret is the words receipts and expenditures. And so government receipts refers to any inflows of money that they are receiving, and expenditure is any money that the government is spending. And so given the context of this year being an election year, we were expecting two different types of budgets to be published. And the purpose of budgetary policy is to give the public a picture about how the government plans to efficiently manage and allocate funds into the economy to help improve living standards and welfare. And so now let's look at these two different dot points. We're looking at the sources of government revenues and also the different types of government expenses. So in the 2022-23 budget, we're looking at what the Morrison government had published. They expected to collect $508.4 billion from taxation, and the three largest sources of taxation is from income taxes, company taxes, and also goods and services taxes. And so you can see that from income taxes, we expect $263.9 billion. From company taxes, the Morrison government expected $90.2 billion. And they also expected $79.4 billion in revenue from GST as well. And so taxation can be broken up into different areas. The first one is direct taxation, and this is where the government collects taxes directly from incomes. And so for examples is personal income tax. Anytime you're working and you earn an income, the government is taking a portion from that. And for company taxes, based on the profits that the company makes, the government is going to take a percentage of that. And anytime you work as well, you're making a contribution to your superannuation, and the government is collecting that from you as well. Now, indirect taxation is when you are getting taxed from the purchases of goods and services. And the reason it's called an indirect tax is because the consumer is ultimately paying for what the business owes to the government. And so let's take, for example, goods and services taxes. The government approaches businesses and they say, for every sale that you make, we are expecting 10% of that revenue to us. And so from the business's perspective, they are not going to simply take on a reduction of 10% in their profits. They're going to pass on that 10% costs onto consumers, which is why every time you make a purchase and you look at your receipt, there is always a GST included, which is an indirect tax. And so the consumer ends up paying for the taxes that the business owes to the government, which is why it's called an indirect tax. Other sources of revenues can be related to government businesses, and this is the profits gained from these enterprises that sell goods and services, and the classic example is Australia Post. But the government can also sell different types of assets. They could sell publicly owned businesses and make it privatized, and so when they sell that off, they're also making money from that. And the example you can think about is also Medibank. It used to be owned by the government, but has now been privatized and therefore sold. And so moving on to government expenses / expenditures, we've learned through our understanding of aggregate demand that the government component is broken up into G1 and G2. And so G1 is current expenditure, and it includes short-term and immediate payments that are required for the economy to function. And so examples is wages for public servants, education, and this could be purchasing educational materials for schools or the public health sector, purchasing medical supplies from the private sector like medication that is then used in hospitals. It is also related to all the costs associated with purchasing vaccines that we have distributed as well. And there's also G2, which is government capital expenditure, and you're thinking about it more relating to investments or relating it to the production side of the economy. And so it relates to more long-term purchases that will help grow the economy's productive capacity. And so you need to be careful because government capital expenditures can be more related to aggregate supply than it is aggregate demand. So examples of capital expenditure could be defense equipment, aircrafts, and tanks. And examples of infrastructures could be bridges, railroads, the East Link. It could also involve new airports, facilities, or buildings as well. Now, in our study of aggregate demand, we always remembered to exclude transfer payments, and we always said that we don't include it into the G component because we know that transfer payments ultimately is spent and decided by the other components because we don't necessarily spend every single dollar that is transferred. However, when we're making our government budgets, it's very important that we include transfer payments because we want a good idea of how much money we are distributing in terms of transfers. So how much are we giving away to student allowances? How much are we paying in pension payments? How much are we paying in unemployment benefits? Even though these payments are considered transfers, they are still types of expenses that the government undergoes. And so the main purpose of any transfer payment is to redistribute final incomes. And what that means is by taxing those that are, for example, employed, and then collecting that money and transferring it to those who are on unemployment benefits is a redistribution because, to put it simply, you are essentially taking money away from those who are more fortunate and those that are currently earning an income and distributing it to those that are less fortunate. And so this allows those less fortunate individuals to access basic goods and services. And so in conclusion, all types of budgetary policies can influence the economy in two ways. It can have a direct influence through spending that will directly influence the G component, thinking about those capital and current types of expenditures, but they could also have an indirect influence where the outlays and taxation changes can influence economic activity through the C and I component. And so obviously we think about transfer payments, but the government could also implement policies that changes tax rates, which may give individuals either more or less disposable incomes. And based on those changes, they're going to be more willing or less willing to spend in the economy. And those type of expenditures will most likely flow through the C and I component. And so that concludes this video. Hopefully you have a better understanding of the different types of government revenues and government expenses.